Hello everyone, welcome back to the Research Analyst series of NISM. Today we will be covering like what are the different ways to issue securities. So there are two ways to issue securities. First one is primary market and second one is secondary market. So let's start covering these two topics. So as stated above, primary market is used by companies or issuers for raising fresh capital from the investors. Primary market offerings may be a public offering or an offer to select groups of investors in a private placement program. The shares offered may be new shares issued by the company, or it may be an offer for sale, where an existing large investor or investors or promoters offer a portion of their holding to the public. Let us understand various terms used in the primary market. The first term is public issue. So securities are issued to the members of the public and anyone eligible to invest can participate in the issue. This is primarily a retail issue of securities. Initial public offering or IPO. So an initial public offer of shares or IPO is the first sale of a corporate's common shares to investors at large. The main purpose of an IPO is to raise equity capital for further growth of the business. Eligibility criteria for raising capital from the public investors is defined by SEBI in its regulations and include minimum requirements for net tangible assets, profitability, and net worth. SEBI's regulations also impose timelines within which the securities must be issued and other requirements, such as mandatory listing of the shares on a nationwide stock exchange and offering the shares in dematerialized form, etc. So SEBI regulation also specifies the proportion of shares to be allocated to different classes of shareholders. According to it, in an eligible issue, at least 35% of shares should be allocated to retail investors who are like who the investors who are investing less than or equal to 2 lakhs in the issue. While at most 50% can be allocated to qualified institutional investors, other investors can be issued the balance. In 2009, SEBI also issued the concept of anchor investor. Anchor investor means a qualified institutional buyer who makes an application for a value of 10 crore rupees or more in a public issue made through the book building process. Anchor investors can be allocated up to 60% of the portion allocated to QIBs. Bidding for them opens one day before the IPO open for public subscription. However, the allocation process for anchor investors can be lower than the final issue price determined through the book building process. The volume and value of anchor subscriptions serve as an indicator of the quality of the offer. Next term we have is follow on public offer or IPO or sorry FPO. When an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public, it is called FPO. When a company wants additional capital for growth or desires to redo its capital structure by retiring debt, it raises equity capital through a fresh issue of capital in a follow-on public offer. A follow-on public offer may be also be through an offer for sale, which usually happens when it is necessary to increase the public shareholding in the company to meet the regulatory requirements. Private placement. It refers to issuing large quantity of shares to a select set of investors according to Companies Act 2013. The number of investors to whom shares are issued under private placement should not exceed 50. Private placements can be in the form of qualified institutional placements, QIP, or preferential allotment. What is QIP? Qualified institutional placements. So QIP is a private placement of shares made by a listing company of to certain identified categories of investors known as qualified institutional buyers or QIBs. QIBs include financial institutions, mutual funds, and banks, among others. So SEBI has defined the eligibility criteria for corporates to be able to raise capital through QIP and other terms of issuance under QIP, such as quantum and pricing, etc. Next term is preferential issue. So preferential issue means an issue of specified securities by a listed issuer to any select person or group of persons on a private placement basis, and it does not include an offer of specified securities made through a public issue. Rights issue, bonus issue, employee stock option scheme, employee stock purchase scheme, or qualified institutions placement or an issue of sweat equity shares or depository receipt issued in a country outside India or foreign securities. The issuer is required to comply with various provisions defined by SEBI, which inter alia includes pricing, disclosures, the notice, lock-in in addition to the requirements specified in the Companies Act. The requirements of SEBI's regulations with respect to a public issue do not apply to a private placement. A privately placed security can be listed on a stock exchange provided it meets the listing requirements of SEBI and the stock exchange. Private placement of securities can be done by a company irrespective of whether it has made a public offer of shares or not. Rights and bonus issues. So securities are issued to existing shareholders of the company as on a specific cutoff date, enabling them to buy more securities at a specific price in case of rights or without any consideration in case of bonus. Both rights and bonus shares are offered in a particular ratio to the number of securities held by investors as on the record date. An investor who has been awarded right shares has three options: exercise the right, transfer the right to another investor, or let the rights lapse, do nothing. On the other hand, in case of bonus, additional shares are conferred onto the existing shareholders, that is without any consideration, in lieu of dividends. Companies can issue bonus shares only if they have sufficient amount of retained earnings. When a bonus issue is made, an amount equivalent to the value of shares issued should be transferred from retaining retained earnings to the share capital. Next one is onshore and offshore offerings. While raising capital, issuers can either issue the securities in the domestic market and raise capital or approach investors outside the country. If capital is raised from the domestic market, it is called onshore offering, and if capital is raised from the investors outside the country, it is termed as offshore offering. Offer for sale or OFS. An offer for sale OFS is a form of share sale where the shares offered in IPO or FPO are not fresh shares issued by the company, but an offer by existing shareholders to sell shares that have already been allotted to them. An OFS does not result in increase in the share capital of the company. Since there is no fresh issuance of shares, the proceeds from the offer to go to offerers, who may be promoters or other large investors. The disinvestment program of the government of India, where the government offers shares held in public sector undertakings, that is PSUs, is an example of OFS. It may be stated that OFS is a secondary market transaction done through the primary market route. Sweat equity. So under Section 54 of Companies Act 2013, a company may issue shares to its employees, promoters, technocrats, or others as reward for their contribution to the company. These shares are referred as sweat equity. The purpose of issuing the share is to motivate employees and top management or any other recipient uh, to work in the interest of the company. It helps reduce the agency risk arising on an account of separation of management and ownership. Although the main purpose of shared equity is not to raise capital, the transaction does involve issuing new shares. Employee stock option scheme or ESOPs. So ESOPs are instruments given by the company to its employees that give them an option to buy the shares of the company at predetermined price after a period of time, that is referred to as vesting period. Typically, the vesting period is more than 1 year, and companies may stipulate additional conditions for vesting, like sweat equity. The objective of issuing ESOPs is to motivate employees to work in the interest of the company. The employees gain only if company's share price rises above the exercise price of the option. The company will have to issue shares if the employee chooses to exercise this option. Next topic is secondary market. We will cover this topic in the next video. That's it for now. Thank you.